What if I told you there is a company sitting on a $66 billion mountain of guaranteed work, and the market just hammered it down nearly 30% in a single trading session? That is not a rumor. That is CoreWeave, the specialized AI cloud infrastructure giant that NVIDIA itself is betting the future on. And here at Smart Stock Sam, when we see a stock collapse like that on record-breaking fundamentals, we do not panic. We pull up the data and find out exactly what is going on. Today, we are doing a full reality check on CRWV. We are going to cover the earnings shock, the absolutely jaw-dropping capex guidance, the short squeeze setup hiding in plain sight, a legal deadline that could flip this entire trade on its head, and where the smartest and most divided analyst community on Wall Street is actually placing their targets. By the time this video ends, you will know whether CoreWeave deserves a spot in your portfolio or if the bears are right and there is 30% more downside still to come. Let us get into it. To understand why this moment is so high stakes, you have to start with the current market setup. Right now, CoreWeave sits at a genuinely pivotal crossroads. On one side of the ledger, you have a record $66.8 billion revenue backlog, the kind of forward visibility that most CEOs would trade their entire compensation package to have. On the other side, the technicals are flashing caution lights in every direction. Over 53 million shares are currently sold short. That is a full 20% of the tradable float. Think about what that means. Every single one of those short sellers has to buy back eventually. And if sentiment shifts, even slightly, that position becomes a powder keg. We also have a new deal with Perplexity AI that shows CoreWeave can win clients outside the Microsoft and OpenAI orbit. But whether that is enough to offset the sheer weight of the numbers we are about to walk through is the real question. And the numbers are where this story gets genuinely complicated. Fiscal year 2025 revenue came in at $5.1 billion. That is a 168% increase year over year. In Q4 alone, the company pulled in over $1.5 billion in a single quarter. If you only looked at the top line, you would think this was one of the greatest growth stories in modern tech. But the bottom line tells a completely different story. CoreWeave reported a GAAP net loss of over $1 billion for the full year. And in Q4, the loss per share hit 89 cents, when Wall Street was only modeling a 49-cent loss. That is not a small miss. That is a signal that the cost of scaling this AI infrastructure is running significantly hotter than anyone originally projected. The bulls will tell you this is the Amazon playbook. Lose money now, own the market forever. But in a high-rate environment, the market runs out of patience faster than Jeff Bezos runs out of rocket fuel. Now, even with those losses, the market might have absorbed the earnings report just fine. What it could not absorb was the capital expenditure guidance that came with it. This is the chart that triggered the 28% plunge. Management guided for 2026 capital expenditures of $30 to $35 billion. For context, they spent approximately $15 billion last year. They are literally doubling their infrastructure spend in a single year, including $8.5 billion in new loan negotiations, just to fund hardware builds for meta platforms. They are constructing what they are calling a gigawatt-sized empire, but they are building it entirely on debt. The critical question every investor has to answer is this: will that $66 billion backlog convert to cash fast enough to cover the interest payments on those loans before the market loses its nerve? The price action after that guidance drop was brutal and precise. CoreWeave came public in March 2025 at $40 a share and ran to an all-time high of $187. Then the earnings report hit, and the stock was repriced 28% lower almost overnight. But here is what is interesting. Over the past several trading sessions, we have seen a 10% recovery back toward the $81 range. That tells us the forced sellers and the panic crowd have largely washed out. Buyers are stepping back in. But as we will see in the technicals, this recovery is running directly into a serious wall of overhead resistance. And if you want to understand why the sentiment on this stock is so completely fractured, look no further than the ownership dynamics. NVIDIA holds an 11.5% stake, 47 million shares. They are not just a chip supplier here, they are a strategic partner with serious skin in the game. Vanguard is in at over 7%. That is institutional conviction at the highest level. But here is the red flag that has every skeptic's antenna up. During Q4, company executives, including the CFO and a co-founder, sold over 4 million shares. When the people who know this company better than anyone alive are reducing exposure while the company is posting billion-dollar losses, you have to at least ask the question, what are they seeing on the inside that we cannot see from the outside? That tension between the bulls and bears is perfectly captured in the analyst community, and I have rarely seen a gap this wide. Oppenheimer has an outperform rating with a price target of $140. Their argument is that CoreWeave is the gigawatt-scale engine of the AI infrastructure build-out, and the addressable market is large enough to justify every dollar of spending. Then you have Bernstein on the complete opposite end with an underperform rating and a $56 target. Their concern is straightforward. Hyperscalers like AWS and Google will eventually stop renting GPU capacity from CoreWeave and shift entirely to their own in-house silicon. If Bernstein is right, we have 30% more downside from current levels. If Oppenheimer is right, this stock doubles from here. The technicals will help us figure out which scenario is actually building. The technical picture right now is a stock that is bruised but not broken. We are trading around $81.50, but we are trapped underneath two major layers of overhead resistance. The 50-day moving average sits at $88. The 200-day is all the way up at $110. Until we reclaim that 50-day line on volume, the bears are technically in control of this chart. The RSI is sitting at 44, neutral, not oversold, not extended. The MACD is still showing lingering bearish pressure. In short, the stock is coiling. It is waiting for a catalyst, and the short interest profile may be exactly where that catalyst comes from. 53 million shares short, 20% of the float. Days to cover at 2.73, meaning it would take nearly 3 full trading days of average volume for short sellers to fully exit their positions. This is textbook stored kinetic energy. One or two additional pieces of positive news and those 53 million shares become forced buyers overnight, blowing straight through the resistance levels we just mapped out. And we may already be seeing those sparks begin to land. On March 4th, CoreWeave announced its deal with Perplexity AI, direct proof that they can win GPU infrastructure contracts outside the Microsoft and OpenAI bubble. Then, just recently, they launched Flexible Capacity, a spot pricing model that allows them to monetize idle GPU inventory. That is a sign of operational maturity. That is a company learning how to squeeze revenue out of every single piece of hardware they own. These are the kinds of incremental wins that start to make short sellers very uncomfortable. But before anyone gets too excited, there is a specific date circled in red on this calendar, March 13th. That is the deadline for the lead plaintiff filing in a securities fraud class action lawsuit against CoreWeave. The allegations center on claims that the company misrepresented its ability to scale operations and concealed data center construction delays ahead of the IPO. Lawsuits are common in the post-IPO lifecycle of high-growth tech names. But the timing here creates genuine binary volatility. If the news flow around this litigation turns negative, it can shut down the recovery rally instantly, regardless of what the short squeeze setup looks like. This is a date-specific event risk that overrides every technical indicator on the board. The options market is already reflecting exactly that tension. We see significant call interest stacked at the $80 and $85 levels. Those are the volatility walls where sellers are positioned. On the downside, there is meaningful put support at $70 and $75. The market is essentially telling you it expects this stock to stay pinned between $70 and $85 through the end of the near-term window. A confirmed break above 85 on volume would be a major signal that the bulls have seized control. So, what does the actual trade setup look like? The entry zone is between $80 and $82. but only on a confirmed break above 80 with volume confirmation. First price target is $95, which fills the post-earnings gap. Target 2 is the analyst consensus area around $122. The full bull case target is $140. On the downside, $74 is your interim support level. $70 is the absolute floor. A close below $70 validates the Bernstein bear case, and that is your exit signal. No exceptions, no holding on hope. Pulling it all together into a final synthesis. In the short term, the opportunity is a potential short squeeze powered by the Perplexity deal and the gap fill to 95. The short-term risk is the March 13th legal deadline and a possible rejection at the 50-day moving average. Long-term, you are making a bet that the $66 billion backlog converts to real cash flow and that margins stabilize before the debt load becomes unmanageable. The long-term risk is the hyperscaler in-house chip threat and $35 billion of leverage hanging over the balance sheet. Before I give you my final take, I want to be clear. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything discussed here is purely for educational and informational purposes only. Always do your own research and consult a qualified professional before making any investment decisions. CoreWeave is on an Amazon-style trajectory. The growth is real, the market fit is proven, and NVIDIA is not an 11.5% stakeholder in companies they do not believe in. But this is a high-wire act over a very long drop. The 20% short interest is the fuel for an explosive move higher, but the litigation risk and the debt structure demand tight risk management at all times. My verdict: speculative buy, but only on a decisive reclaim of the $88 50-day moving average. Until that happens, patience is the edge. Watch March 13th like a hawk. Keep your stop at $70. And do not size this position beyond what you can afford to lose entirely. This is a gigawatt-scale opportunity. Just make sure you respect the voltage. Smart Stock Sam out. Drop your price target for CoreWeave in the comments below. Smash that like button if this breakdown gave you clarity, and subscribe so you never miss the next deep dive setup before the crowd finds it.